Markets have been rallying as the Trump administration hints that the trade war with China will ease. Let's get an update on things going on in the market with David Dietze, Chief Investment Strategist at Dietze Wealth Management Group. Thanks for joining us today.
Good afternoon. Great to be with you.
Do you see the hints from the administration in Washington as a reaction to the market spiraling?
Yes, I do. I mean, I think we're dealing with a situation where, although President Trump has his objectives that he wants to meet in terms of tariffs, revenue raising, and resetting the trade balance, he's also a capitalist. He's also a businessman. He's from New York, and he's sensitive, too, to, I think, these market gyrations. So I really do think that there's a type of Trump put where if the market reacts badly enough, he's going to react and take some pressure off the gas pedal. And that's what I think we've seen this week. Okay, so let's talk about what investors need to do here, where they should be looking, because some are looking to other continents, right, for some stability where markets are doing better. Are they better off, do you think, buying the dips here or moving to the other markets? Well, I think it's a combination, but certainly I think in the last few years, investors have become over allocated to U.S. assets. And that's kind of quite clear when you just look at the composition of global stocks. It's gotten to the levels in terms of U.S. dominance of those that have never really been seen before. And so now the problem is with stocks more highly valued than the rest of the world, with now new questions as to American exceptionalism, super high valuations here, and now there's volatility. I think that's giving a wake-up call for investors worldwide to reallocate their assets, and I think a lot of that is going to Europe, Japan, the emerging markets, and I think that makes sense. You know, on the other hand, at a certain level, of course, we still have some of the best technology on the planet. We still have some of the best managed companies. We have a government that ultimately does want this market to be successful. So on this big enough pullbacks, I think you got to be agile enough to pick up your favorite bargains. So we are seeing the pullbacks. Of course, we don't know how far down we've gone, whether we've bottomed out or not. So are you telling people then to dip in? Selectively, of course. So, you know, here's the negatives to that is we still don't have a cheap market. I mean, we don't have dividend yields 4, 5, 6% like we saw in the great financial crisis. We're not technically, insofar as the S&P 500 is concerned, in a bear market. I think we briefly put our nose into bear market territory intraday, but we didn't close at a bear market low. So the sell-offs haven't been that bad. On the other hand, of course, we have seen some VIX levels that have been rising to historic proportions. We have certainly seen some of the worst negative sentiment, particularly among retail investors. So I think, you know, no one's going to ring the bell at the bottom. So I think what you want to do is on negative days, take out your shopping list, selectively nibble, but I don't think anyone can call an absolute bottom and say it won't be lower after I buy today.
It'd be so much easier if they rang the bell when that happened, as you say. Okay, let's get to your stock picks today, starting with Intel. I'm wondering whether government support in the U.S. would be enough to help Intel sort of catch up with everybody else.
It's certainly helping. I mean, if there's any symbol of the strength of U.S. technology and build what we need in America now, it's Intel. So the whole government, the whole economy is rooting for Intel to be successful. I think investors have some advantages. The stock is down by more than half in just the last 16 months here. But this year, of course, we've seen the relative strength start to improve. Intel's down around 5 or 6% year to date. Most of their peers in the semi group are down from 20% down to as much as 50% in terms of Marvell. We've got some, the biggest development, I think, is Intel is working on a so-called 18A technology, which could help give it a lead over AMD and NVIDIA. We're waiting to see that. Intel has other drivers it can pull, including separate its design and fabrication. I heard what I thought was very good news, and so did the market, when the new management, Mr. Tan, announced that he's going to slash 20% of the workforce. That's not an easy step for a new executive to do, but he's walking the talk here, and the stock is up around 7% on news that he's serious about cutting costs. The stock trades at a valuation advantage to the rest of the summaries, so I think this stock could easily be up 50% over the next 24 to 48 months.
Okay, let's also get to Fizer, big pharma, of course, but you have a new U.S. health secretary who has very different ideas and philosophies. So why do you like Fizer at this point?
So, yeah, RFK Jr., of course, has struck fear in the whole healthcare area. If you're a vaccine maker, of course, there's fear that vaccines will be, downplayed, not permitted, not recommended. There's also talk about putting special sector tariffs on, for example, drugs and pills coming in from the United States. Trump wants to make drug prices here the same as overseas, where they're generally cheaper. So there's a lot of negative headwinds. But for the whole healthcare sector, particularly Fizer, I believe those are priced in. For example, Pfizer is now trading with a dividend yield in excess of 7%. That suggests to me that the market thinks it's going to be slashed, and it may well be. But the fact of the matter is, Pfizer's got this, research and development program that is second to none. All sorts of new compounds are coming on. Albert Bourla, the CEO, is one of the best in the business, in my view. It's got an international reach, and at the end of the day, never underestimate the power of the pharmaceutical lobbyists in Washington. It's hard to push them around. And Trump may have met his match if he really tries to inflict serious pain on the healthcare industry. No one's been able to do it before. It's unlikely to happen now. It's already priced in. Okay,
I do want to get to your last pick, which is Exxon. And I'm just wondering, we've got a lot going on with oil. We're seeing OPEC saying it's going to continue to open its taps. We're seeing Russia might be able to come back online at some point. So I'm just wondering what you see for Exxon performing in the state we're in today.
Well, we start by looking at the commodity prices. They're down in the low 60s. Well, that's in U.S. dollars. If you're sitting in Europe or Japan, take another 10% off year to date. So energy is extremely cheap. At a certain point, actually, producers do the opposite. They say it's not worthwhile to keep cranking up production. Let's hold off on production. So there's going to be some sort of floor in the commodities. On top of that, I see worldwide global stimulus. Whether you're in Japan, Europe, China, everyone wants to get their economies going. Everyone's trying to provide more monetary stimulus. The Europeans, of course, are busting their budget in order to provide for more defense spending. I think ultimately we'll be cutting interest rates here too. And so I think ultimately you get this, the global economy back on its feet. I think that's going to be a boost to energy prices. Meanwhile, Exxon's off more than 20% from its recent high, has a great dividend. And of course, given its size, global reach, integration from upstream all the way down to downstream, it's got the best advantages of any energy company out there. So even if industry conditions stay weak, Exxon benefits from that as they take market share.
David Dietze, I appreciate you joining us today, sir. I got to let you go. We're out of time with you. David, of course, is the chief investment strategist at Dietze Wealth Management.